us unpack these developments from the World Bank's gross downgrade to the implications of a credit squeeze on Nigeria's manufacturing base is a man who closely tracks economic and policy trends. He is a finance analyst, public affairs commentator, and the CEO of Finance with Muktar. Many thanks for joining me, Muktar Mohammed.
Thank you, Justin. My pleasure to be on your program as usual. Thank you for having me.
All right, it's like almost like a double down for the country. But now, how significant is the World Bank's downgrade in terms of investor confidence and government policy direction?
Well, I think, Justin, we've had this conversation on your program over and over again.
Yes, we have.
World Bank policies are not really working in Nigeria as it stands. Because again, you are doing a policy that seems to favor a certain class of business, a certain class of people, and then you have a larger class of people suffering in the short term and telling them they have hope in the long term to survive. So for me, I think World Bank policies are not really working, not just in Nigeria, in Africa. We've had this conversation. I think it's high time African leaders begin to look at how they can also get an homegrown policy to grow the economy with the help of the World Bank, maybe looking at how a different means of strategizing for Africa. Because the orthodox monetary policy is killing the most vibrant sector in the African economy, which is the creative sector, which is the informal sector. And it's causing a lot of problem that has to do with high cost of funding, lack of credit for expansion, and other numerous challenges that they are facing.
Okay, now let's talk about trade issues. I want to just break it down. In as much as we have had this conversation before, but how does how do these trade issues affect local businesses in Nigeria? What with the World Bank talking about global growth coming downgrade? It will still simmer down to the country here, Nigeria. So let's talk about how the global economic policies now with the trade issues in Trump and other parts of the world is actually bringing it down to Nigeria's nitty-gritty.
Yes, Justin, you could see that in terms of trade policies, I keep saying why we continue to have the challenges we have is because Africa don't do much trade within themselves. We depend so much on trading with the Chinese, with the Europeans, with the Americans. And so any trade issues from those countries seems to affect us here also. I think that's what we are suffering for at the moment. The African Continental Trade Agreement that is supposed to be a game changer is not working yet because a lot of African countries, especially Nigeria, don't want to see their place as a dumping ground for other African goods because, again, those bring us back to the cost of production if you have to produce those goods in Nigeria compared when you produce it in other African countries. So in terms of trade dispute, that affects us because we are doing more trade with this with the Americans, with the European Union, with the Chinese. And if you look at the trade war as it stands now, it's between the Chinese and the America, and they say when two elephants fight, the grass definitely suffer. And I think that's why we are seeing those spill over to Africa. Hopefully, it will not go further than what we have seen because we are beginning to see there's light in the tunnel. Maybe there will be an agreement between the United States and the Chinese. But if that doesn't come, it's definitely affect Africa. Ordinarily, again, this should be a game changer for Africa. Africa is supposed to be the bright that everybody will sort for. But unfortunately, again, we have a challenge that have to do with infrastructural decay. So we are not able to take advantage of this trade war that is happening between the developed nations.
Okay, now let's talk about the manufacturing sector and the banks slashing their loans by 26% to 8 trillion naira. Well, this sharp drop in bank loans to manufacturers, what message does this send about the health of the real sector?
Justin, I don't know why we are being surprised because, again, when you look at we will come back again to the monetary policy of the CBN. When you look at that monetary policy of the CBN, it seems to favor banks just keeping those money in their books, and they get high interest. You look at the bank's balance sheet, you've seen that a lot of most of their profit are gotten through treasury bill, fixed income bills, and other investment they are doing by the CBN. So, and that CBN is using that as a tool to fight inflation. And so, if you are in a bank and you look at the risks involved in the manufacturing sector, especially with the low earning ability of the average Nigerian and the cost of goods and services, you won't be encouraged to give loan to that sector, because the payback, the means of paying back is definitely not there. Most of the loans that you are seeing that the banks are suffering from, that has to do with non-performing loans at the moment, are largely driven by the manufacturing sector. So you look, as a bank, you want to create value for your shareholders. You don't want to do any risky investment or risky giving of loans. As it stands now, it's very risky to give loans to the manufacturing sector, because again, you are giving this loan at a high interest rate. You are looking at patronage. Most of these manufacturing sectors are suffering from patronage. So you look for a safe haven, and unfortunately, the government have created that safe havens in terms of government securities, and these are safer for the bank. So the bank rather invest in those securities than give money to a risky sector like the manufacturing sector.
So as it stands now, this credit crunch in manufacturing, is it a temporary risk adjustment or a sign of a deeper financial stress?
I think it's risk adjustment. I don't think there's so much of financial stress. It's all about risk adjustment. The banks are looking at, like I said, the risky nature of loaning to the manufacturing sector, not really about whether it's under financial stress. Most of these banks are highly capitalized, and we keep saying it. They are still highly capitalized. Some of them are still also in the process of doing their recapitalization drive. So I don't think it has anything to do with that, but I strongly believe that it has a lot to do with the risky nature of investing there rather than the pressure.
Okay, now, so what impact might this have on job creation, industrial output, and Nigeria's long-term growth?
The manufacturing sector is key to any economy, and if we are looking at sustaining our economy in terms of we are trying to make sure that we are not so much import dependent, then we need to work on our manufacturing sector, so that they will need to provide some of the basic necessities rather than importing it into this country. So the impact is huge, but again, is not something that is not surmountable. Like I said, why we are seeing that now is because of the high interest rate environment. Hopefully, going forward, we'll begin to see those rate cuts that we've all been expecting for a while. If that comes in, then that will be a game changer. But if we continue the way we are now with the kind of policy that is being driven, we will continue to suffer from these challenges that has to do with that. And again, when you have this manufacturing sector suffering, then you have high unemployment. And forget about the way the Nigerian Bureau of Statistics is measuring their employment data. As it stands now, we have more Nigerians unemployed than employed. And even those that are employed, some of them are underemployed. And some of them also are losing their job because of the shrink that they are seeing in the manufacturing sector.
Okay, now, so what are the options? What are the alternatives now for the manufacturers? What should they be exploring right now? Because some time ago, the president came up with wonderful ideas to help boost manufacturing, SMEs, nano manufacturers, and enterprises. So what financing alternatives should they be exploring right now?
I think they should be exploring the capital market.
Okay.
It seems to be one of the cheapest areas where they can access funding. And I hope they will take advantage of that and begin to access the capital market. It will be a game changer for them if they are able to access the capital market as it stands now. It seems to be one area that they will have cheap funding, but do they have the capacity to access the capital market? And most of them are also going into commercial papers, trying to access funding through issuing of commercial papers. But again, most of the companies that are doing this like commercial paper are the larger company compared to the smaller manufacturing companies. So I think that's what they need to exploit.
Okay, now let's talk about where other people could come in terms of government, maybe DFIs, BOI, DBN. What kind of intervention can be more effective?
Just to reverse some of these interventions, but it seems not to be seeing the results. And because some of these interventions are are not tied to structural interventions. We need to begin to look at intervention in terms of structural intervention, not just intervention in the name that you need to intervene to make sure that that sector is working for political relevance. You need to come up with the structures that people will begin to see results in those interventions. Because as it stands now, we are not seeing so much result in some of this intervention because structurally they are faulty. And so that for me is the biggest challenge that we are facing at the moment. If all these institutions you just mentioned, if they have to intervene, they have to look at it, intervene in what area, rather than just generally intervening in giving of fund. They must begin to look at structural intervention and a way to implement this intervention rather than just intervening direct by injecting funds into some of these companies.
Okay, speaking of specifics now, should there be sector-specific credit policies to protect critical industries from loan withdrawal?
They should be. I'm telling you, Justin, they should be. But again, unfortunately, we've seen those interventions before, but they were marked with political issues, and so we did not see the kind of result that we should see. Remember, before now, critical intervention were coming from the central bank. Remember the rise intervention scheme, the manufacturing intervention scheme going at a single digit. There's a lot of intervention scheme that has come up because the structure is not strongly looked at. When you think about the structures of how these loans are being given, they were hijacked for political reasons, and we don't see the kind of gain that we ought to see. Trader money, remember that also, were all good policy, but they were hijacked politically because we didn't create that structure for them. So the support that most of all these companies need is in terms of low cost of funding, and to do that there must be an intervention between critical intervention from the Central Bank of Nigeria through the federal government and also most of these owners in this manufacturing sector for us to begin to get the kind of results that we think we should have.
Okay, now so what's your outlook for the second half of 2025, and what policy shifts do you think are very, very, very urgent as we round off now?
Well, the policy shift that I think is very urgent for me is that rate cut rather than the hawkish nature that we have seen thus far. If that happens, that will be a game changer for the money. We need to see in the exchange rate not just maintaining that corridor. If that happens, that will be good for the manufacturing sector. We need also to see government intervention in critical area, but this intervention should be done with a structural reforms that will definitely help us see results in some of this intervention. For me, those are those critical interventions that we need at this three stage. I mean, these 3 points that are given are what we need, especially because this will also help address the cost of funding that is making most goods very expensive and not allowing a lot of Nigerians to patronize some of these goods when they are being produced.
Okay, and half-year outlook?
Justin, from where I'm sitting, I think half-year outlook looks positive. I mean, you must say it looks positive. If you look at the rating we've gotten from international rating agencies, stable, the terms of exchange rate maintaining a corridor of stability, we expect that to continue. We may continue to have that 1,600 as the support level for the naira to the dollar. The CBN has said they want to make the currency competitive. They are making it competitive, and now we begin to look towards stability. And so I think I'm of the opinion that the second quarter might be better than what we have we've achieved thus far because of what I just mentioned in terms of the microeconomy. We begin to see those short-term gains in some of these reforms, especially what we are seeing in the oil and gas sector begin to trickle down into other areas of the Nigerian economy. You know fully well that Nigerian economy is a petrol-driven economy. So once you begin to enjoy a type of discount in the petroleum sector, it may take time, but you begin to see those short-term benefit in terms of cost of production, in terms of movement of goods and services, and that will also have an impact in the long term for the economy.
All right, thank you so much, Muktar Mohammed, for your insight on the show today. We do appreciate it.
Thank you for having me, Justin.
All right, as we've heard, Nigeria's economy is feeling the squeeze from downgraded growth expectation to a major pullback in industrial credit. For manufacturers and policymakers alike, the time to act is now. But that's all for this edition of Business Insights. Keep the conversation going online. Follow us on Atlas TV Africa. I am Justin Akadonye. Thanks for watching and see you again next time. Bye for now.